Question 1. Process analysis reveals that a principal in a New York-based broker-dealer needs to optimize the review of internal communications to ensure compliance with FINRA Rule 3110-06. Which of the following approaches would best achieve this objective while maintaining effective supervision? Option A. Utilize automated keyword scanning software to flag potentially problematic internal communications, with minimal human oversight for the flagged items. Option B. Establish a review process that primarily focuses on the number of internal communications sent by each representative, giving more scrutiny to those with higher volumes. Option C. Conduct a comprehensive line-by-line review of every internal communication generated by all registered representatives, regardless of content or context. Option D. Develop and implement a risk-based review system that prioritizes internal communications based on factors such as the nature of the communication, the representative involved, and the potential for client impact. Correct answer is D. Develop and implement a risk-based review system that prioritizes internal communications based on factors such as the nature of the communication, the representative involved, and the potential for client impact. Explanation. Scenario analysis. This scenario presents a common challenge for principals overseeing registered representatives. The core difficulty lies in balancing the need for efficient communication and supervision with the regulatory imperative to ensure all client-facing correspondence adheres to strict compliance standards. A principal must identify potential risks within internal communications that could inadvertently lead to non-compliant external communications or reflect poorly on the firm's commitment to regulatory adherence. The challenge is to optimize the review process without creating undue bottlenecks or missing critical compliance issues. Correct approach analysis. The best professional practice involves implementing a risk-based review methodology for correspondence and internal communications. This approach prioritizes review efforts based on the potential for compliance violations or reputational damage. It requires the principal to develop clear criteria for identifying high-risk communications, such as those involving new product offerings, complex financial strategies, or direct client recommendations. By focusing resources on these areas, the principal can ensure that the most critical communications receive thorough scrutiny, thereby optimizing the review process while maintaining robust compliance. This aligns with FINRA Rule 3110-06, which mandates that firms establish and maintain supervisory procedures, including the review of communication, and encourages a risk-based approach to identify and mitigate potential violations. Correct approach is analysis. Reviewing all internal communications with the same level of intensity as external client correspondence is inefficient and impractical. While thoroughness is important, an undifferentiated approach fails to leverage resources effectively and can lead to delays in addressing genuinely high-risk issues. This approach does not align with the spirit of risk-based supervision, which aims to allocate supervisory attention where it is most needed. Focusing solely on the volume of communications processed by each representative, without considering the content or context, is a superficial metric. High volume does not inherently equate to high risk, nor does low volume guarantee compliance. This method overlooks the qualitative aspects of communication and the potential for significant compliance breaches in even a small number of messages. It fails to meet the regulatory expectation of actively supervising for compliance. Implementing a review process that relies exclusively on automated keyword searches without human oversight is also problematic. While technology can assist in identifying potential issues, it cannot fully grasp the nuances of communication, intent, or context. Automated systems may flag legitimate communications as problematic or miss subtle compliance violations that a trained principal would recognize. This approach risks both over-censorship and under-supervision, failing to provide the necessary depth of analysis required by regulatory standards. Professional reasoning. Professionals should adopt a proactive and analytical mindset when reviewing communications. This involves understanding the firm's business, the products and services offered, and the regulatory landscape. A risk-based framework should be established, identifying factors that increase the likelihood of compliance issues. This framework should guide the allocation of supervisory resources, ensuring that communications with higher potential for risk receive more intensive review. Regular training and updates on regulatory requirements and emerging risks are crucial for principals to effectively implement and adapt their review processes. The goal is to create a system that is both effective in identifying and mitigating risks and efficient in its operation. Question 2. The control framework reveals that a FINRA member firm, currently operating with a registered main office in Nevada, is opening a new branch office in Sacramento, California. The firm's compliance department is discussing the necessary steps to ensure regulatory compliance for this new location. Which of the following actions is the most appropriate and compliant course of action? Option A. Delay filing any amendment to Form BD until the firm's next annual renewal, as the new branch is not the main office. Option B. File an amendment to the firm's Form BD with FINRA, clearly indicating the new branch office address in Sacramento and designating a qualified registered principal to supervise its activities. Option C. Assume that since the firm already has a registered main office, no separate registration is required for the new branch office. Option D. Begin operations at the new Sacramento branch office immediately, with the understanding that a registered principal will be assigned and registered at a later date. Correct answer is B. File an amendment to the firm's Form BD with FINRA, clearly indicating the new branch office address in Sacramento and designating a qualified registered principal to supervise its activities. Explanation. The control framework reveals a potential oversight in the registration process for a newly established branch office of a FINRA member firm in California. The challenge lies in ensuring strict adherence to FINRA Rule 3110.01, which mandates the registration of all main offices and requires firms to designate a principal responsible for supervising the activities of each branch office. Misinterpreting or neglecting these requirements can lead to regulatory sanctions, reputational damage, and potential harm to investors. Careful judgment is required to identify the correct registration procedure and avoid costly errors. The correct approach involves promptly filing a new Form BD with FINRA, accurately reflecting the new branch office location, and designating a qualified principal to supervise its operations. This aligns with FINRA Rule 3110.01's requirement for firms to maintain a record of their main office and any branch offices, and to have a registered principal responsible for each location. This proactive and compliant action ensures that the firm operates within regulatory boundaries from the outset of its new branch's operations. An incorrect approach would be to assume that since the firm already has a registered main office, no separate registration is needed for a new branch. This fails to recognize that FINRA Rule 3110.01 specifically addresses the registration of both main and branch offices. Another incorrect approach would be to delay filing the Form BD amendment until the next annual renewal cycle. This violates the spirit and letter of the rule, which requires timely notification of office locations and supervisory personnel. Finally, attempting to operate the new branch without designating a registered principal would be a direct contravention of the supervisory requirements outlined in FINRA Rule 3110.01, exposing both the firm and its representatives to significant risk. Professionals should approach such situations by first thoroughly understanding the specific regulatory requirements for office registration and supervision. This involves consulting the relevant FINRA rules, such as Rule 3110.01 and any applicable state securities regulations. When a new office is established, the immediate step should be to review the firm's compliance manual and consult with the Chief Compliance Officer or designated compliance personnel to ensure all necessary filings and designations are made promptly and accurately. A proactive approach, prioritizing regulatory compliance, is essential to avoid potential disciplinary actions and maintain the integrity of the firm's operations. Question 3. Governance review demonstrates that a registered broker-dealer firm in California is providing its clients with weekly market commentary that includes detailed analysis of specific sectors and buy or sell recommendations for individual stocks. While the firm explicitly states in its disclaimers that this commentary is for educational purposes only and not personalized advice, clients frequently contact their registered representatives to discuss these specific recommendations and how they should adjust their portfolios accordingly. Which of the following approaches best reflects compliance with the Securities and Exchange Commission's (SEC) regulations regarding the definition of an investment advisor under the Investment Advisors Act of 1940? Option A. The firm must cease providing specific stock recommendations and detailed sector analysis that could be construed as personalized advice, and instead focus its client communications on general market trends and educational concepts without referencing specific securities. Option B. The firm should continue providing its weekly market commentary, including specific stock recommendations, but strengthen its disclaimers to more forcefully state that the information is not advice and that clients should consult an independent financial advisor. Option C. The firm should register as an investment advisor with the SEC to legally provide the current level of detailed market analysis and stock recommendations to its clients. Option D. The firm can continue its current practice, as long as it does not charge a separate fee for the market commentary, and the information is presented as educational material. The correct answer is A. The firm must cease providing specific stock recommendations and detailed sector analysis that could be construed as personalized advice, and instead focus its client communications on general market trends and educational concepts without referencing specific securities. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires distinguishing between providing general financial information and offering personalized investment advice. The firm's actions, while seemingly helpful, could inadvertently cross the line into regulated activity without proper registration or adherence to fiduciary duties. Careful judgment is required to ensure compliance with the Securities and Exchange Commission (SEC) regulations under the Investment Advisors Act of 1940, specifically concerning the definition of an investment advisor. Correct approach analysis. The best professional practice involves clearly delineating the scope of services offered. This means ensuring that any educational materials or general market commentary provided by the firm are presented in a way that does not solicit or provide specific investment advice tailored to individual client circumstances. The firm should maintain a strict policy that prohibits its representatives from recommending specific securities or investment strategies based on a client's personal financial situation, risk tolerance, or investment objectives. This approach aligns with the SEC's interpretation of an investment advisor, which typically involves providing advice about securities for compensation. By avoiding personalized recommendations and focusing on general education, the firm remains outside the definition of an investment advisor, thus avoiding registration and fiduciary obligations under the Act. Incorrect approaches analysis. One incorrect approach is to continue providing detailed market analysis and hot stock tips to clients, even if framed as general information. This crosses the line because the specificity and directness of the information, when delivered to clients with the expectation of influencing their investment decisions, can be construed as personalized advice. This failure to distinguish between general education and specific advice risks violating the Investment Advisors Act of 1940 by operating as an unregistered investment advisor. Another incorrect approach is to assume that because the firm does not charge a separate fee for this educational content, it is exempt from the definition of an investment advisor. The Investment Advisors Act of 1940 defines an investment advisor broadly, and compensation can be indirect. If the firm benefits from increased client assets under management or trading volume due to this advice, it can be considered compensation. This approach ignores the substance of the activity over its form and can lead to regulatory violations. A further incorrect approach is to rely solely on disclaimers stating that the information is for educational purposes only. While disclaimers can be a component of a compliance strategy, they are not a shield against regulatory scrutiny if the actual conduct of the firm constitutes providing investment advice. The SEC looks at the totality of the circumstances, and if the firm's actions consistently lead clients to believe they are receiving personalized recommendations, disclaimers alone will not absolve them of responsibility. Professional reasoning. Professionals must adopt a proactive and conservative approach to compliance. When in doubt about whether an activity constitutes investment advice, it is prudent to err on the side of caution and seek clarification from legal counsel or compliance departments. The key is to understand the intent and impact of communications. If the communication is likely to influence an investor's decision regarding securities, it is likely to be considered advice. Professionals should regularly review their marketing materials, client communication, and service offerings to ensure they are not inadvertently engaging in activities that require registration or adherence to specific fiduciary standards. Question 4. Governance review demonstrates that a registered principals firm in Ontario, Canada, has historically held its annual compliance meeting in the final quarter of its fiscal year. However, due to significant operational demands and a recent product launch, the principal is considering rescheduling the meeting to the first quarter of the next fiscal year, or potentially canceling it altogether if operational pressures persist. What is the most appropriate course of action for the principal to ensure the firm remains compliant with regulatory expectations? Option A. Postpone the annual compliance meeting indefinitely until operational pressures subside, prioritizing immediate business needs over the scheduled compliance review. Option B. Proactively schedule the annual compliance meeting for the upcoming fiscal year, even if it requires a slight adjustment to the original timeline, to ensure timely discussion and review of compliance matters. Option C. Conduct a brief, informal meeting that covers only the most critical compliance updates, deeming it sufficient given the current operational demands. Option D. Delegate the sole responsibility for organizing and conducting the annual compliance meeting to a junior compliance associate, with minimal direct oversight from the principal. The correct answer is B. Proactively schedule the annual compliance meeting for the upcoming fiscal year, even if it requires a slight adjustment to the original timeline, to ensure timely discussion and review of compliance matters. Explanation. Governance review demonstrates a potential lapse in a firm's adherence to regulatory requirements concerning annual compliance meetings. This scenario is professionally challenging because it requires the principal to balance immediate operational pressures with long-term regulatory obligations and ethical responsibilities. The firm's success and reputation depend on demonstrating a commitment to compliance, which is not merely a procedural hurdle, but a fundamental aspect of investor protection and market integrity. The principal must make a judgment call that prioritizes compliance without unduly disrupting business operations, a common tension in principal-level decision-making. The best approach involves proactively scheduling the annual compliance meeting for the upcoming fiscal year, even if it requires a slight adjustment to the original timeline. This proactive stance acknowledges the regulatory mandate for an annual meeting to discuss compliance matters, including any new or revised rules, and to review the firm's compliance program. By scheduling it in advance, the firm signals its commitment to ongoing compliance and provides ample opportunity for all relevant personnel to attend and participate meaningfully. This aligns with the spirit and letter of regulations that emphasize regular oversight and education on compliance. It allows for thorough preparation, discussion of critical issues, and the implementation of any necessary corrective actions, thereby fulfilling the purpose of the annual meeting as intended by regulators. An approach that postpones the meeting indefinitely until a more convenient time is ethically and regulatorily unsound. This demonstrates a disregard for the mandatory nature of the annual compliance meeting, which is designed to ensure continuous awareness and adherence to compliance standards. Such a delay could lead to a failure to address emerging compliance risks or regulatory changes in a timely manner, potentially exposing the firm and its representatives to disciplinary action. Another unacceptable approach is to hold a perfunctory meeting that merely ticks a box without substantive discussion or review of compliance issues. This undermines the purpose of the annual meeting, which is to foster a culture of compliance and to actively identify and mitigate risks. Regulators expect a genuine engagement with compliance matters, not a superficial exercise. This approach fails to provide meaningful training or oversight and could be viewed as an attempt to circumvent the spirit of the regulation. Finally, attempting to delegate the entire responsibility for the annual compliance meeting to a junior compliance officer without adequate oversight or support from senior management is also problematic. While delegation is a necessary management tool, the ultimate responsibility for ensuring compliance rests with the principal. This approach risks the meeting being inadequately planned or executed, and it fails to demonstrate the firm's leadership's commitment to compliance. Professionals should approach such situations by prioritizing regulatory obligations and investor protection. This involves understanding the specific requirements of the relevant jurisdiction, such as the annual compliance meeting mandate, and proactively planning to meet these obligations. A robust decision-making framework includes assessing the potential impact of different actions on compliance, business operations, and the firm's reputation, and always erring on the side of caution when it comes to regulatory adherence. Question 5. Governance review demonstrates that the Chief Compliance Officer, CCO, of a registered investment advisory firm in California, who is also a significant shareholder, has identified a potential conflict of interest. A newly recruited financial advisor, who is a close personal friend of the CCO, wishes to sell a proprietary variable annuity product with a high commission structure. The CCO is aware of the advisor's aggressive sales history and the product's commission details, while also facing pressure to increase firm revenue. Which of the following represents the most appropriate course of action for the CCO? Option A. Approve the advisor's sale of the proprietary product, relying on the advisor's assurance that they will act in the client's best interests. Option B. Instruct the advisor to downplay the commission structure of the proprietary product to clients while still allowing the sale. Option C. Monitor the advisor's sales of the proprietary product without immediate escalation or disclosure, believing they can manage the situation internally. Option D. Immediately escalate the situation to the firm's legal counsel and the board of directors, providing full disclosure of the potential conflict of interest, the advisor's background, and the nature of the proprietary product. Correct answer is D. Immediately escalate the situation to the firm's legal counsel and the board of directors, providing full disclosure of the potential conflict of interest, the advisor's background, and the nature of the proprietary product. Explanation. Governance review demonstrates a potential conflict of interest within a registered investment advisory firm in California. The firm's chief compliance officer, CCO, is also a significant shareholder and has been actively involved in recruiting new financial advisors. One of these advisors, a close personal friend of the CCO, has a history of aggressive sales tactics and has expressed interest in selling a proprietary, high-commission variable annuity product that is not widely available through other distributors. The CCO is aware of the advisor's past performance and the product's commission structure, but is also under pressure from senior management to increase firm revenue. This scenario is professionally challenging because it pits the CCO's fiduciary duty to clients and regulatory obligations against personal relationships and business pressures. Careful judgment is required to ensure that client interests and regulatory compliance are prioritized above all else. The best approach involves the CCO immediately escalating the situation to the firm's legal counsel and the board of directors, providing full disclosure of the potential conflict of interest, the advisor's background, and the nature of the proprietary product. This approach is correct because it adheres to the fundamental principles of good corporate governance and regulatory compliance, particularly under California's securities laws and the Investment Advisors Act of 1940. By disclosing the conflict and seeking independent oversight, the CCO fulfills their duty to act in the best interest of the firm and its clients, ensuring that decisions are made objectively and in accordance with regulatory requirements. This proactive disclosure prevents potential violations and demonstrates a commitment to ethical conduct, an approach where the CCO approves the advisor's sale of the proprietary product, relying on the advisor's assurance that they will act in the client's best interests, is professionally unacceptable. This fails to address the inherent conflict of interest and the CCO's knowledge of the advisor's aggressive sales history and the product's high commission. It implicitly condones a situation where client interests may be compromised for financial gain, potentially violating fiduciary duties and California's regulations regarding suitability and conflicts of interest. Another unacceptable approach is for the CCO to instruct the advisor to downplay the commission structure of the proprietary product to clients, while still allowing the sale. This constitutes a deceptive practice and a failure to provide full and fair disclosure, which is a direct violation of securities regulations and ethical standards. It actively attempts to circumvent transparency, further increasing the risk of client harm and regulatory scrutiny. Finally, an approach where the CCO decides to monitor the advisor's sales of the proprietary product without immediate escalation or disclosure, believing they can manage the situation internally, is also professionally unsound. While monitoring is part of compliance, failing to disclose a significant conflict of interest and potential risk to senior management and legal counsel is a dereliction of duty. This passive approach allows the conflict to persist and potentially lead to client harm or regulatory violations before any effective intervention can occur. Professionals should employ a decision-making framework that prioritizes transparency, ethical conduct, and regulatory compliance. When faced with a potential conflict of interest, the immediate steps should be to identify the conflict, assess the potential risks, and then disclose the situation to appropriate oversight bodies within the organization, such as legal counsel and the board. This ensures that decisions are made with full awareness of all relevant factors and in adherence to legal and ethical obligations. Question 6. Governance review demonstrates that a Series 26 principal is facing a significant inquiry from the U.S. Securities and Exchange Commission, SEC, that could potentially lead to disciplinary action. The principal believes this situation may necessitate their resignation from their position. Considering the regulatory environment in California, which of the following actions best reflects professional and ethical conduct? Option A. Delay notifying the Chief Compliance Officer and legal counsel about the SEC inquiry until after the resignation has been formally submitted. Option B. Resign from the firm without notifying the Chief Compliance Officer or legal counsel to avoid further complications. Option C. Immediately inform the firm's Chief Compliance Officer and legal counsel about the SEC inquiry and the potential for resignation, seeking their guidance on the appropriate steps. Option D. Attempt to negotiate a private settlement with the SEC regarding the inquiry before informing anyone at the firm. Correct answer is C. Immediately inform the firm's Chief Compliance Officer and legal counsel about the SEC inquiry and the potential for resignation, seeking their guidance on the appropriate steps. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a principal to balance their fiduciary duty to the firm and its clients with the personal and professional implications of a serious regulatory inquiry. The principal must act with integrity and transparency, while also protecting their own interests and ensuring the firm's continued compliance. The pressure of a potential regulatory action, coupled with the responsibility of overseeing the firm's operations, necessitates careful judgment and adherence to established procedures. Correct approach analysis. The best professional practice involves immediately notifying the firm's Chief Compliance Officer, CCO, and legal counsel about the SEC inquiry and the potential for resignation. This approach is correct because it ensures that the firm is fully informed of a material event that could impact its regulatory standing and operational continuity. Prompt disclosure to internal compliance and legal experts allows for a coordinated and informed response to the SEC, minimizing potential prejudice to the firm and the principal. It also aligns with the ethical obligation of transparency and the regulatory expectation that firms maintain robust internal controls and reporting mechanisms. This proactive communication facilitates the proper handling of the resignation process, ensuring it is conducted in accordance with FINRA Rule 1210 and other applicable regulations, and that any necessary filings are made accurately and promptly. Incorrect approaches analysis. Resigning immediately without informing the CCO or legal counsel is professionally unacceptable. This action bypasses crucial internal oversight and deprives the firm of the opportunity to manage the situation strategically. It could be interpreted as an attempt to evade responsibility or to avoid scrutiny, potentially leading to more severe regulatory consequences for both the individual and the firm. Furthermore, it fails to comply with the spirit, if not the letter, of regulations requiring prompt reporting of significant events that could affect a firm's registration or operational status. Attempting to negotiate a private settlement with the SEC without involving the firm's legal counsel and CCO is also professionally unsound. This approach undermines the firm's compliance infrastructure and could lead to agreements that are not in the best interest of the firm or its clients. It also risks violating internal policies and external regulations that mandate the involvement of legal and compliance departments in all regulatory interactions. Such an action could be seen as an attempt to conceal information or to circumvent established procedures, jeopardizing the firm's reputation and regulatory standing. Delaying notification to the CCO and legal counsel until after the resignation is finalized is a critical ethical and regulatory failure. This approach creates a significant information gap within the firm, preventing timely and appropriate action. It suggests a lack of commitment to the firm's compliance obligations and could be viewed as an attempt to control the narrative or to limit the firm's awareness of the situation. This delay can hinder the firm's ability to respond effectively to the SEC, potentially leading to increased penalties and reputational damage. It also fails to uphold the principle of open communication and cooperation that is fundamental to maintaining regulatory compliance. Professional reasoning. Professionals facing such a dilemma should always prioritize transparency and adherence to established internal procedures. The decision-making framework should involve 1. Immediate internal reporting of any material regulatory inquiry or event to the designated compliance and legal personnel. 2. Seeking guidance from these internal experts on the appropriate course of action, considering both personal and firm-level implications. 3. Ensuring all actions taken are in full compliance with applicable regulations, including those governing resignations and reporting obligations. 4. Acting with integrity and a commitment to the firm's and clients' best interests throughout the process. Question 7. Market research demonstrates that associated persons in California may not fully grasp the implications of signing the arbitration disclosure on Form U-4. As a principal at a FINRA member firm, what is the most prudent course of action when a new registered representative signs their Form U-4, acknowledging the arbitration provisions? Option A. Accept the signed Form U-4 and assume the associated person has read and understood the arbitration disclosure, as they have provided their signature. Option B. Engage in a direct conversation with the associated person to explain the arbitration clause, its implications, and answer any questions they may have about resolving disputes through arbitration rather than court. Option C. Instruct a junior administrative assistant to briefly review the arbitration section with the associated person to confirm acknowledgement. Option D. Provide the associated person with a standard company pamphlet on arbitration and consider the disclosure complete once they have received it. The correct answer is B. Engage in a direct conversation with the associated person to explain the arbitration clause, its implications, and answer any questions they may have about resolving disputes through arbitration rather than court. Explanation. Scenario analysis. This scenario presents a common challenge for principals overseeing registered representatives. The core issue revolves around ensuring that associated persons fully understand and acknowledge their obligations regarding arbitration, a critical component of dispute resolution within the securities industry. A principal's responsibility is not merely to ensure a form is signed, but to confirm the associated person comprehends the implications of that signature, particularly concerning the waiver of certain rights. Failure to do so can lead to regulatory violations and expose both the firm and the individual to unforeseen legal complications. Correct approach analysis. The best professional practice involves the principal actively engaging with the associated person to explain the arbitration clause on Form U-4. This approach ensures the individual understands that by signing, they are agreeing to resolve disputes through arbitration rather than litigation in court. This proactive explanation fulfills the principal's supervisory duty to ensure compliance with FINRA Rule 13200 series and related disclosure requirements, which mandate that associated persons acknowledge their agreement to arbitrate. It also ethically ensures the associated person is making an informed decision. Incorrect approaches analysis. One incorrect approach is to simply accept the signed Form U-4 without any further discussion, assuming the associated person has read and understood the document. This fails to meet the principal's supervisory obligation to ensure understanding of critical disclosures, bypasses the opportunity to clarify the implications of agreeing to arbitration, which is a significant waiver of rights. Another incorrect approach is to delegate the explanation of the arbitration clause to a junior administrative staff member. While administrative staff can handle form processing, the responsibility for ensuring a registered person understands the implications of signing Form U-4, especially regarding arbitration, rests with the principal. This delegation abdicates a key supervisory duty. A third incorrect approach is to provide the associated person with a generic, pre-written explanation of arbitration that is not tailored to their specific questions or concerns. While some explanation is better than none, a truly effective approach requires a dialogue where the principal can address any ambiguities or misunderstandings the associated person may have, ensuring genuine comprehension. Professional reasoning. Professionals should approach the acknowledgement of Form U-4 with a mindset of informed consent and robust supervision. The decision-making process should prioritize ensuring the associated person fully grasps the significance of the arbitration clause. This involves not just verifying a signature, but actively facilitating understanding through clear communication and addressing any questions. When in doubt about an associated person's comprehension, a principal should err on the side of providing more explanation and clarification. Question 8. During the evaluation of a registered investment advisor's operational status in California, the principal discovers that a significant change in the firm's ownership structure occurred 45 days ago, which materially alters the control of the firm. The firm's Form ADV has not yet been amended to reflect this change. What is the principal's most appropriate course of action? Option A. Immediately prepare and file an amendment to the firm's Form ADV reflecting the ownership change. Option B. Assume that changes in ownership structure do not require an amendment unless explicitly instructed by the SEC. Option C. Instruct the administrative staff to make a note of the ownership change for potential inclusion in the next filing, without immediate action. Option D. Wait until the firm's next annual filing deadline to update the Form ADV with this ownership change. The correct answer is A. Immediately prepare and file an amendment to the firm's Form ADV reflecting the ownership change. Explanation. This scenario presents a professional challenge because it requires a principal to exercise judgment regarding the timely and accurate filing of crucial regulatory documents. The principal must balance the need for efficient business operations with the strict legal and ethical obligations to maintain accurate and up-to-date records with the Securities and Exchange Commission, SEC, in the United States. Failure to do so can result in significant penalties, reputational damage, and potential disciplinary actions. The correct approach involves proactively identifying the need for amendments and ensuring they are filed promptly. This demonstrates a commitment to regulatory compliance and transparency. Specifically, when a firm's business activities or organizational structure change in a way that necessitates an update to its Form ADV, the principal has a duty to ensure these changes are reflected in the filing. The SEC's rules, particularly Rule 204-1 under the Investment Advisors Act of 1940, mandate that registered investment advisors amend their Form ADV to reflect material changes no later than 30 days after the occurrence of the material change. This proactive and timely amendment process is critical for maintaining the integrity of the public record and ensuring investors have access to accurate information about their advisors. An incorrect approach would be to delay filing the amendment until the next scheduled annual filing. This fails to meet the explicit requirement of Rule 204-1b, 3, which mandates amendments for material changes within 30 days. This delay deprives investors and the SEC of timely information about the firm's operations and potential conflicts of interest, which is a direct violation of regulatory obligations. Another incorrect approach would be to assume that minor changes in personnel do not constitute a material change requiring an amendment. Definition of material change under SEC guidance is broad and includes significant changes in the nature of the investment advisory business, ownership, control, or the firm's financial condition. Failing to assess whether personnel changes, such as the departure of key personnel or the addition of new principals, constitute a material change, and thus require an amendment is a failure to adhere to the spirit and letter of the regulations. Finally, an incorrect approach would be to rely solely on the firm's administrative staff to track and file amendments without principal oversight. While delegation is necessary, the ultimate responsibility for compliance rests with the principal. Failing to establish a robust internal control system that ensures timely and accurate filings, including principal review and approval, demonstrates a lack of due diligence and oversight, which is a regulatory failure. Professionals should adopt a decision-making framework that prioritizes regulatory compliance. This involves establishing clear internal procedures for identifying and reporting material changes, setting deadlines for amendments that are well within the regulatory timeframes, and implementing a system of principal review and approval for all regulatory filings. Regular training on regulatory requirements and a culture of proactive compliance are essential to prevent violations. Question 9. What factors determine the appropriate timing and process for registering a new associate with a broker-dealer in the Central Registration Depository, CRD, registered system in California, particularly when the individual has prior registration history? Option A. allowing the new associate to begin performing registered duties while the firm awaits confirmation of their previous registration status from FINRA. Option B. Initiating the filing of a uniform application for securities industry registration or transfer, Form U-4, with the CRD system immediately upon the individual's acceptance of employment and prior to them commencing any registered activities. Option C. Delaying the filing of the Form U-4 until after the new associate has completed their initial training and begun client interactions. Option D. Assuming the individual's prior registration status automatically remains valid for the new firm without requiring a new Form U-4 filing. The correct answer is B. Initiating the filing of a uniform application for securities industry registration or transfer, Form U-4, with the CRD system immediately upon the individual's acceptance of employment and prior to them commencing any registered activities. Explanation. This scenario presents a common challenge for principals overseeing a broker-dealer's registration and personnel management. The principal must ensure compliance with FINRA rules regarding the registration of associated persons, specifically when an individual transitions from one firm to another. The challenge lies in accurately identifying the correct registration status and ensuring no gaps or improper continuations of employment occur, which could lead to regulatory violations and potential disciplinary action. The correct approach involves proactively initiating the filing of a uniform application for securities industry registration or transfer, Form U-4, for the new associate with the CRD system immediately upon the individual's acceptance of employment. This ensures that the individual's registration is processed promptly and that they are properly registered to conduct business on behalf of the new firm. This aligns with FINRA Rule 1010 series, which mandates that all persons associated with a broker-dealer in a capacity requiring registration must be registered with FINRA through the CRD system. Prompt filing prevents the individual from engaging in unregistered activity, which is a serious violation. An incorrect approach would be to allow the new associate to begin performing registered duties before their Form U-4 has been filed, and their registration status is confirmed as active in the CRD system. This creates a significant regulatory risk, as the individual would be operating as an unregistered person, violating FINRA Rule 1010. Another incorrect approach is to assume that the individual's previous registration status automatically transfers or remains valid without a new filing, as each new employment with a member firm requires a new or amended Form U-4 to be filed. Finally, delaying the filing until after the individual has already commenced their duties, even if the intention is to file it shortly thereafter, still exposes the firm and the individual to the risk of unregistered activity and is not in line with the principle of proactive compliance. Professionals should adopt a decision-making framework that prioritizes proactive compliance and thoroughness. This involves understanding the specific registration requirements for each type of associated person and each transition scenario. Before an individual begins any activity that requires registration, the principal must verify that the necessary filings have been submitted and that the CRD system reflects an active and appropriate registration status. Establishing clear internal procedures for onboarding new registered personnel, including checklists and timelines for form submissions, is crucial to prevent regulatory oversights. Question 10. Benchmark analysis indicates that a principal for a U.S.-based mutual fund, Growth Opportunities Fund, is reviewing the daily net asset value (NAV) calculation. The fund's total market value of securities is $50,000,000. Accrued management fees for the period are $15,000, and accrued administrative expenses are $5,000. The fund has 1,000,000 shares outstanding. If the principal incorrectly uses the average purchase price of securities instead of their current market value, and also fails to deduct the accrued administrative expenses, what would be the resulting NAV per share compared to the correct NAV per share? Assume the average purchase price of securities is $48 per share. Option A. The incorrect NAV per share would be $48.00, which is $2.00 lower than the correct NAV per share. Option B. The incorrect NAV per share would be $50.00, which is $2.00 lower than the correct NAV per share. Option C. The incorrect NAV per share would be $50.00, which is $2.00 higher than the correct NAV per share. Option D. The incorrect NAV per share would be $48.00, which is $2.00 higher than the correct NAV per share. The correct answer is A. The incorrect NAV per share would be $48.00, which is $2.00 lower than the correct NAV per share. Explanation. This scenario is professionally challenging because it requires a principal to accurately calculate the net asset value, NAV, of a mutual fund, which is fundamental to the fair pricing of fund shares. Miscalculations can lead to significant financial discrepancies for both the fund and its investors, potentially violating regulatory requirements for accurate record-keeping and fair dealing. The principal must demonstrate a thorough understanding of the components that affect NAV and the correct application of accounting principles. The correct approach involves meticulously calculating the fund's total assets, subtracting its total liabilities, and then dividing the result by the number of outstanding shares. This method directly aligns with the definition of NAV as prescribed by the Investment Company Act of 1940 in the United States. Specifically, Section 2(a)(42) defines the value of any security, and Section 2(a)(41) mandates that the NAV be computed on the basis of the market value of the issuer's assets less liabilities. This approach ensures that the NAV accurately reflects the fund's per share worth at specific valuation time, upholding the principle of fair pricing for all shareholders, both incoming and outgoing. An incorrect approach would be to simply average the purchase prices of the fund's securities. This fails to account for accrued income, expenses, and the current market value of assets, leading to an inaccurate NAV. Ethically and regulatorily, this is unacceptable as it does not reflect the true economic value of the fund's holdings and would result in mispricing of shares. Another incorrect approach would be to exclude certain accrued expenses from the liability calculation. The Investment Company Act of 1940 requires all liabilities to be deducted to arrive at the NAV. Omitting expenses, such as management fees or administrative costs, would artificially inflate the NAV, again leading to mispricing and potential violations of fair dealing principles. A further incorrect approach would be to use the cost basis of the securities instead of their current market value when calculating total assets. Section 2(a)(41) of the Investment Company Act of 1940 explicitly requires the use of market value for computing NAV. Using cost basis ignores market fluctuations and does not provide an accurate reflection of the fund's current worth, leading to an incorrect NAV and potential investor harm. Professionals should approach NAV calculation by adhering strictly to the regulatory definitions and accounting principles. This involves a systematic process of identifying all assets, valuing them at current market prices, identifying all liabilities, and then performing the division by the outstanding shares. Regular review and reconciliation of these calculations are essential to ensure accuracy and compliance. Question 11. The audit findings indicate that a registered broker-dealer firm in California has inadvertently been operating for 2 weeks without its firm registration being current with FINRA, while its individual representatives' registrations remain active. The firm's public website and marketing materials have not yet been updated to reflect this lapse. What is the most appropriate immediate course of action for the firm? Option A. Assume the 2-week lapse is minor and will be addressed during the next routine examination, focusing only on completing the registration renewal. Option B. Continue business operations as usual while internally working to expedite the firm registration renewal process and update the firm's website. Option C. Immediately cease all business activities that require firm registration and promptly notify FINRA of the error and the steps being taken to rectify it. Option D. Update the firm's website and marketing materials to accurately reflect the current registration status, and then proceed with business activities. The correct answer is C. Immediately cease all business activities that require firm registration and promptly notify FINRA of the error and the steps being taken to rectify it. Explanation. The audit findings indicate a potential violation of FINRA Rule 2010, which requires associated persons to observe high standards of commercial honor and the principles of fair dealing in the conduct of their business. Specifically, the scenario presents a challenge because it involves a firm's registration status, a fundamental aspect of its ability to operate legally and ethically. Misrepresenting this status can mislead investors and regulators, undermining the integrity of the securities markets. The professional challenge lies in accurately and promptly addressing the misrepresentation to rectify the situation and prevent further harm. The best approach involves immediately ceasing all business activities that require registration and notifying FINRA of the error. This directly addresses the core issue of operating without proper registration. By halting the unauthorized activities, the firm prevents further violations and potential harm to clients. Promptly informing FINRA demonstrates a commitment to regulatory compliance and transparency, which is crucial for maintaining trust and mitigating penalties. This proactive stance aligns with the ethical obligation to conduct business with integrity and to correct errors swiftly. An incorrect approach would be to continue business operations while attempting to rectify the registration issue internally without informing FINRA. This prolongs the period of non-compliance and exposes the firm and its clients to greater risk. It also suggests a lack of transparency and a potential attempt to conceal the violation from the regulator, which is a serious ethical and regulatory failure. Another incorrect approach would be to only update the firm's website and marketing materials to reflect the correct registration status without ceasing operations or notifying FINRA. While updating materials is a necessary step, it does not address the fundamental issue of conducting business without the required registration. This approach fails to stop the ongoing violation and does not fulfill the obligation to inform the regulator of the discrepancy. A further incorrect approach would be to assume that the registration error is minor and will be overlooked by FINRA, and therefore take no immediate action. This demonstrates a disregard for regulatory requirements and a failure to understand the seriousness of operating without proper registration. Such an assumption is a significant ethical lapse and can lead to severe consequences. Professionals should employ a decision-making framework that prioritizes immediate compliance and transparency. When an issue of registration status arises, the first step should always be to verify the accuracy of the information, and if a discrepancy is found, to immediately cease any activities that require the missing or incorrect registration. Concurrently, the relevant regulatory bodies must be notified promptly and truthfully. This proactive and transparent approach is essential for maintaining regulatory standing and ethical conduct. Question 12. The monitoring system demonstrates that a registered representative has submitted a written request from a client to transfer their investment account to another broker-dealer located in New Jersey. As the principal responsible for overseeing this process, what is the most appropriate and compliant course of action to ensure adherence to FINRA regulations regarding account transfers in New Jersey? Option A. Immediately initiate the transfer process upon receipt of the written request, ensuring all required documentation is complete and accurate, and provide the client with an estimated timeline for completion. Option B. Inform the client that the transfer will be processed only after the firm has contacted their new broker-dealer to confirm the client's intent to transfer. Option C. Inform the client that the transfer will be delayed due to a high volume of account transfers, suggesting it may take several weeks to complete. Option D. Delay the transfer until the firm has completed its internal audit of the client's account activity to ensure no compliance issues are present. The correct answer is A. Immediately initiate the transfer process upon receipt of the written request, ensuring all required documentation is complete and accurate, and provide the client with an estimated timeline for completion. Explanation. This scenario is professionally challenging because it requires a principal to balance the firm's operational needs with strict adherence to regulatory requirements concerning the transfer of customer accounts. Mismanagement of this process can lead to significant regulatory penalties, customer dissatisfaction, and reputational damage. Careful judgment is required to ensure all regulatory obligations are met promptly and accurately. The best professional approach involves immediately initiating the transfer process upon receiving the customer's written request, ensuring all necessary documentation is complete and accurate, and communicating the expected timeline to the customer. This approach is correct because FINRA Rule 11,870, Transfer of Customer Accounts, mandates prompt transfer of accounts upon written instruction. The rule emphasizes that firms must not unreasonably delay the transfer. By acting immediately and ensuring completeness, the principal demonstrates compliance with the spirit and letter of the rule, prioritizing customer rights and regulatory obligations. This proactive stance also minimizes the risk of the customer perceiving the delay as an attempt to retain their business, which could lead to complaints. An incorrect approach involves delaying the transfer until the firm has completed its internal audit of the customer's account activity. This is professionally unacceptable because FINRA Rule 11,870 does not permit internal audits or other internal processes to be used as a reason to withhold or delay the transfer of an account once a written request has been received. The rule's focus is on the prompt execution of the customer's instruction, not on the firm's internal administrative convenience or risk mitigation unrelated to the transfer itself. Another incorrect approach is to inform the customer that the transfer will be processed only after the firm has contacted their new broker-dealer to confirm the customer's intent. This is professionally unacceptable, as it shifts the burden of confirmation onto the customer and delays the process unnecessarily. FINRA Rule 11,870 requires the firm to act upon the customer's written instruction, not to seek external validation of that instruction from the receiving firm before initiating the transfer. A further incorrect approach is to inform the customer that the transfer will be delayed due to a high volume of account transfers, suggesting it may take several weeks to complete. While high volume can be a practical challenge, it does not excuse non-compliance with the prompt transfer requirement under FINRA Rule 11,870. Firms are expected to manage their resources to meet regulatory obligations, and citing general high volume as a reason for significant delay without specific, justifiable circumstances, which are not present here, is a failure to adhere to the rule's mandate for promptness. Professionals should employ a decision-making framework that prioritizes regulatory compliance above all else when handling account transfers. This involves understanding the specific requirements of FINRA rules, such as Rule 11,870, and establishing internal procedures that facilitate prompt execution. When faced with a customer request, the immediate step should be to verify the request's completeness and initiate the transfer process, communicating transparently with the customer about the expected timeline. Any internal processes or concerns should be addressed concurrently or after the transfer is initiated, without impeding the customer's right to move their assets. Question 13. Operational review demonstrates that a financial services firm operating in California primarily engages in executing securities transactions for its clients, earning commissions on these trades. However, the firm also offers personalized investment strategies and ongoing portfolio management advice to a select group of clients for an annual fee, separate from any transaction-based compensation. Considering the regulatory landscape in California, which approach best reflects the firm's likely regulatory obligations? Option A. The firm's FINRA registration as a broker-dealer exempts it from any additional registration requirements in California, even when providing advice for a fee. Option B. The firm is solely a broker-dealer because its primary business is executing securities transactions, and its advisory services are incidental to this core function. Option C. The firm can operate under its broker-dealer registration for all its activities, as long as the advisory fees are clearly disclosed as part of its overall service offering. Option D. The firm must assess whether its advisory services for a fee-trigger investment advisor registration requirements in California, in addition to its broker-dealer registration, and comply with both regulatory frameworks. The correct answer is D. The firm must assess whether its advisory services for a fee-trigger investment advisor registration requirements in California, in addition to its broker-dealer registration, and comply with both regulatory frameworks. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of the distinct regulatory frameworks governing registered investment advisors, RIA, and broker-dealers, BD, in California. Misinterpreting these distinctions can lead to significant compliance violations, reputational damage, and potential disciplinary actions. The core challenge lies in recognizing that, while both entities operate within the securities industry, their registration, fiduciary duties, and permissible activities are fundamentally different under California state law and federal securities laws as administered by the Securities and Exchange Commission, SEC, and FINRA. Correct approach analysis. The best professional practice involves accurately identifying the entity's primary business activity and its corresponding regulatory classification. If the firm's core business is providing investment advice for compensation, it must register as an investment advisor with the state of California or the SEC if thresholds are met. If its primary activity is effecting securities transactions for others, and it holds itself out as such. It must register as a broker-dealer with FINRA and the state of California. The approach that correctly distinguishes these roles is to assess whether the firm's compensation structure and the nature of its services align with the definition of an investment advisor, providing advice for a fee, or a broker-dealer, earning commissions on transactions. This aligns with the regulatory intent to ensure that those providing advice are held to a fiduciary standard, while those facilitating transactions are subject to suitability and other broker-dealer specific rules. Incorrect approaches analysis. One incorrect approach is to assume that because a firm effects securities transactions, it is solely a broker-dealer, even if it also provides investment advice for a fee. This fails to recognize that a firm can be duly registered and must comply with both sets of regulations. California law, like federal law, mandates registration as an investment advisor for those providing advice for compensation, regardless of their broker-dealer status. Another incorrect approach is to believe that if a firm is registered as a broker-dealer, it is automatically exempt from investment advisor registration requirements, even when providing advice for a fee. This overlooks the investment advisor definition, which is based on the nature of the service provided, advice, and the compensation received, not solely on broker-dealer registration. A further incorrect approach is to focus solely on the firm's FINRA membership as the defining characteristic of its regulatory status. While FINRA registration is crucial for broker-dealers, it does not negate the requirement for investment advisor registration if the firm engages in activities that fall under the definition of an investment advisor under California law. Professional reasoning. Professionals must adopt a proactive and diligent approach to regulatory classification. This involves a thorough understanding of the definitions of investment advisor and broker-dealer, as defined by the California Corporations Code, Division 1, Title 10, Chapter 5, Article 1, and relevant federal regulations. When evaluating a firm's business model, professionals should ask, is the primary revenue stream derived from advice or from facilitating transactions? Is the firm holding itself out as a fiduciary providing ongoing advice, or as an agent executing trades? This analytical framework, grounded in the specific regulatory definitions and the firm's actual business practices, is essential for accurate classification and compliance. Question 14. The performance metrics show a significant increase in client acquisition in California, prompting the firm's principal to review the team responsible for this growth. The principal needs to ensure that all individuals involved in soliciting securities business and providing investment advice in California are properly registered according to SEC, FINRA, and California state requirements. Which of the following actions best ensures compliance with these jurisdictional mandates? Option A. Proactively verify that all individuals engaging in securities-related activities in California have obtained the necessary SEC, FINRA, and California state registrations, or have pending applications that are being diligently processed prior to commencing their activities. Option B. Assume that individuals holding active FINRA registrations and previously registered in other states are automatically permitted to solicit business and provide advice in California. Option C. Focus on ensuring all registrations are in order only when an upcoming SEC or FINRA examination is scheduled for the California branch. Option D. Allow individuals to begin soliciting securities business and providing investment advice in California while their registration applications are still pending with the SEC, FINRA, and the state of California. The correct answer is A. Proactively verify that all individuals engaging in securities-related activities in California have obtained the necessary SEC, FINRA, and California state registrations, or have pending applications that are being diligently processed prior to commencing their activities. Explanation. This scenario is professionally challenging because it requires a principal to balance the need for efficient business operations with strict adherence to regulatory registration requirements. Misinterpreting or overlooking these requirements can lead to significant compliance failures, including fines, disciplinary actions, and reputational damage for both the firm and the individuals involved. The principal must exercise careful judgment to ensure all personnel engaging in regulated activities are properly registered in the relevant jurisdiction. The best approach involves proactively identifying individuals who require registration and ensuring their applications are submitted and approved by the appropriate regulatory bodies, before they commence any activities requiring such registration. This includes understanding the specific registration requirements for principals, registered representatives, and other personnel under the purview of the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA, in the United States, as well as any additional state-specific requirements in California. This proactive stance ensures compliance from the outset, minimizes risk, and demonstrates a commitment to regulatory integrity. An incorrect approach would be to assume that individuals who have previously held registrations in other states are automatically cleared to conduct business in California. State securities laws, often referred to as blue sky laws, require specific registration or notice filing in each state where a firm or its associated persons conduct business. Failing to verify and complete California-specific registration processes before allowing individuals to engage in regulated activities in California is a direct violation of California's securities regulations and SEC/FINRA rules regarding broker-dealer registration. Another incorrect approach is to allow individuals to begin performing activities that require registration while their applications are pending. While efficiency is important, regulatory requirements for registration are typically absolute and must be met prior to engaging in the regulated activity. Permitting unregistered activity, even temporarily, exposes the firm and the individuals to significant regulatory scrutiny and potential penalties. This demonstrates a disregard for the fundamental principles of securities regulation, which prioritize investor protection through qualified and registered professionals. Finally, an incorrect approach is to only address registration requirements when an audit or examination is imminent. Regulatory compliance is an ongoing responsibility, not a reactive measure. Waiting for an audit to ensure registration is complete indicates a lack of robust internal controls and a failure to maintain a culture of compliance. This reactive stance increases the likelihood of discovering non-compliance at an inconvenient time, potentially leading to more severe consequences. Professionals should adopt a framework that prioritizes understanding and adhering to all applicable federal and state registration requirements. This involves establishing clear internal policies and procedures for identifying personnel requiring registration, managing the registration process from application to approval, and conducting regular reviews to ensure ongoing compliance. A proactive and diligent approach to registration is fundamental to maintaining regulatory compliance and protecting both the firm and its clients. Question 15. Cost-benefit analysis shows that implementing a comprehensive electronic surveillance system for all registered representatives' communications and trades in Ontario would be significantly more expensive than the current manual review process. As the principal responsible for supervision, which of the following approaches best aligns with the regulatory requirements for maintaining an effective supervisory system? Option A. Delegate the responsibility for reviewing a larger portion of communications and trades to junior administrative staff, with minimal oversight from the principal, to reduce costs. Option B. Invest in a basic, lower-cost electronic surveillance tool that covers only a limited scope of communications and trades, deeming it a sufficient upgrade from the manual process. Option C. Enhance the existing manual review process by increasing the frequency of spot checks on a random selection of registered representatives' communications and trades, and implement a more detailed checklist for reviewers to ensure consistency. Option D. Continue with the current manual review process, focusing solely on responding to client complaints and any red flags that are immediately apparent without additional proactive measures. The correct answer is C. Enhance the existing manual review process by increasing the frequency of spot checks on a random selection of registered representatives' communications and trades, and implement a more detailed checklist for reviewers to ensure consistency. Explanation. This scenario presents a common challenge for principals in the Canadian securities industry, specifically under Ontario Securities Commission, OSC, Rule 31-505 Registration Requirements, and related guidance on supervision. The challenge lies in balancing the need for efficient and cost-effective supervision with the absolute regulatory requirement to ensure that registered individuals are acting in the best interests of clients and adhering to all applicable securities laws and firm policies. Principals must implement a supervisory system that is robust enough to detect and prevent misconduct, even when resources are constrained. The correct approach involves a proactive and systematic implementation of supervisory procedures that are tailored to the firm's business and the risks associated with its registered representatives. This includes establishing clear policies and procedures, providing adequate training, conducting regular reviews of trading activity and client communications, and utilizing technology where appropriate to enhance oversight. The regulatory framework, particularly the duty of supervision imposed on registered firms and their principals, mandates that such systems be designed to achieve compliance and protect investors. This approach directly addresses the requirements of OSC Rule 31-505 by ensuring that supervision is not merely a perfunctory exercise, but an integral part of the firm's operations designed to mitigate risk and uphold ethical standards. An incorrect approach would be to rely solely on reactive measures, such as addressing issues only after a client complaint or regulatory inquiry arises. This fails to meet the proactive supervisory obligations under OSC Rule 31-505, which requires firms to have systems in place to prevent misconduct, not just to react to it. Another incorrect approach is to delegate supervisory responsibilities without adequate oversight or to implement a system that is demonstrably insufficient to monitor the activities of registered representatives, such as relying on infrequent or superficial reviews. This demonstrates a failure to establish and maintain a supervisory system that is reasonably designed to achieve compliance with securities laws and regulations, thereby exposing the firm and its clients to undue risk. Finally, an approach that prioritizes cost savings over the effectiveness of the supervisory system, leading to understaffing or inadequate technology, directly contravenes the regulatory imperative to ensure proper supervision. Professionals should approach supervisory system design by first understanding the specific risks inherent in their firm's business model and the types of products and services offered. This understanding should then inform the development of clear, documented policies and procedures. Regular training and ongoing monitoring are crucial, and principals must be empowered to adapt the system as business activities evolve or new risks emerge. The ultimate goal is to create a culture of compliance where supervision is viewed as a critical function that protects both the firm and its clients. Question 16. System analysis indicates that a registered principal in California is overseeing the establishment of a new operational site for their firm. This site will house administrative staff and will also be used by several registered representatives for client meetings on an occasional basis. Given the potential for this location to be classified as a branch office under regulatory definitions, what is the most prudent and compliant course of action for the principal to ensure adherence to FINRA and California state securities regulations? Option A. Proceed with setting up the new site, and if the California Department of Financial Protection and Innovation or FINRA inquires about the location during a routine examination, then begin the registration process. Option B. Designate the new location solely as an administrative support office and forego registration, assuming that occasional client meetings by registered representatives do not meet the threshold for a branch office designation. Option C. Immediately initiate the formal branch office registration process with FINRA and the California Department of Financial Protection and Innovation, ensuring all required documentation and fees are submitted prior to or concurrent with the commencement of business operations at the new site. Option D. Wait to register the location until the firm has operated there for at least 6 months to gather data on the volume of client interactions before determining if registration is necessary. Correct answer is C. Immediately initiate the formal branch office registration process with FINRA and the California Department of Financial Protection and Innovation, ensuring all required documentation and fees are submitted prior to or concurrent with the commencement of business operations at the new site. Explanation. Scenario analysis. This scenario presents a common challenge for principals overseeing a growing financial services firm in California. The principal must balance the need for efficient operational expansion with strict adherence to FINRA and California state regulations regarding branch office registration. Failure to properly register a new location can lead to significant regulatory sanctions, including fines, disciplinary actions, and reputational damage, impacting both the firm and the principal's personal registration. The challenge lies in understanding the nuances of what constitutes a branch office and ensuring all necessary steps are taken proactively. Correct approach analysis. The best professional practice involves proactively identifying the new location as a potential branch office and initiating the registration process with FINRA and the California Department of Financial Protection and Innovation, DFPI, immediately upon its establishment. This approach demonstrates a commitment to regulatory compliance and minimizes risk. The principal should consult the relevant FINRA Rule 3110 and California Corporations Code sections pertaining to branch office registration requirements. This includes understanding the definition of a branch office, which typically encompasses any office or location from which a member firm's associated persons regularly conduct business, or where customer accounts are maintained. By filing the necessary forms e.g., FINRA Form BD, Schedule C, and any state-specific forms, and paying the required fees before or immediately upon commencement of business at the new location, the firm ensures it is operating in full compliance. This proactive stance prevents potential violations and demonstrates a robust compliance culture. Incorrect approaches analysis. Delaying the registration until after the office has been operational for a period, or until an audit or inspection prompts it, constitutes a significant regulatory failure. This approach violates the spirit and letter of FINRA Rule 3110 and California regulations, which require timely registration. Such a delay creates a period of non-compliance, exposing the firm and the principal to disciplinary action. Treating the new location as a temporary administrative hub without considering its function in relation to customer interaction or the regular conduct of business by associated persons is also a failure. The definition of a branch office is functional, not solely based on its designation or duration. If associated persons conduct business or customer accounts are serviced from this location, it likely meets the definition of a branch office, regardless of its perceived administrative nature. Failing to consult with the firm's compliance department or legal counsel regarding the registration requirements for the new location is a critical oversight. While the principal has ultimate responsibility, seeking expert guidance is a crucial step in ensuring accurate interpretation and application of complex regulations. Relying solely on personal interpretation without verification can lead to unintentional violations. Professional reasoning. Professionals in this position should adopt a risk-based, proactive compliance framework. When considering a new physical location where firm business will be conducted, the first step should always be to consult the firm's compliance manual and relevant regulatory guidance. FINRA Rule 3110, California Corporations Code. This should be followed by a direct inquiry to the Compliance Department or external legal counsel specializing in securities regulation to determine if the location meets the definition of a branch office. If it does, the registration process must be initiated immediately, adhering to all filing deadlines and requirements. This systematic approach ensures that operational needs are met without compromising regulatory obligations, fostering a culture of integrity and minimizing potential liabilities. Question 17. The performance metrics show a substantial uptick in sales of a specific variable annuity product by a registered representative in California. The branch manager, a principal, is aware that this representative had a customer complaint filed against them 2 years ago, which was resolved to the customer's satisfaction, and that the representative has a history of minor, non-financial regulatory infractions in other states. What is the most appropriate course of action for the principal to ensure regulatory compliance and investor protection? Option A. Conduct a thorough documented review of the representative's complete background, including the resolved complaint, all past disciplinary actions from any jurisdiction, and their financial history, in conjunction with the firm's supervisory policies and relevant FINRA and California regulations. Option B. Rely on the representative's assurance that they have learned from past experiences and focus solely on monitoring the current sales activity for any new issues. Option C. Immediately escalate the situation to senior management and consider placing the representative under heightened supervision without a detailed review of the historical context of the past issues. Option D. Acknowledge the increased sales performance and assume the representative's past issues are not relevant given the positive resolution of the complaint and the non-financial nature of other infractions. The correct answer is A. Conduct a thorough, documented review of the representative's complete background, including the resolved complaint, all past disciplinary actions from any jurisdiction, and their financial history, in conjunction with the firm's supervisory policies and relevant FINRA and California regulations. Explanation: the performance metrics show a significant increase in sales for a particular variable annuity product in California. This scenario is professionally challenging because it requires a principal to balance the firm's growth objectives with stringent regulatory requirements concerning the hiring and supervision of registered representatives, particularly when past issues might be present. Careful judgment is needed to ensure compliance without unfairly penalizing individuals or hindering legitimate business operations. The best approach involves a thorough, documented review of the representative's background, including any disciplinary actions, customer complaints, or financial history, in conjunction with the firm's internal policies and FINRA Rule 3110, Supervision, and California Corporations Code Section 25210. This proactive and comprehensive due diligence ensures that any potential risks associated with the representative are identified and appropriately managed before or during their association with the firm, aligning with the principle of investor protection and regulatory oversight. This approach directly addresses the pre-hire requirements and ongoing supervisory responsibilities mandated by regulators. An approach that overlooks or downplays past customer complaints, even if they were resolved, is professionally unacceptable. This failure to conduct a complete background check violates the spirit and letter of regulatory requirements designed to prevent individuals with a history of misconduct from engaging in activities that could harm investors. Similarly, focusing solely on the increased sales performance without considering the representative's history ignores potential red flags and creates an environment where past issues could be repeated, leading to further complaints and regulatory scrutiny. Relying on informal assurances from the representative or their previous supervisor without independent verification also constitutes a significant regulatory failure, as it bypasses the necessary due diligence and documentation required for proper supervision. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves establishing clear internal policies for background checks and ongoing supervision that exceed minimum regulatory standards. When evaluating a representative, especially one with a history that may include complaints or disciplinary actions, a systematic process of gathering all relevant information, assessing the nature and severity of past issues, and determining the appropriate level of supervision is crucial. This process should be documented thoroughly to demonstrate compliance and provide a clear audit trail. Question 18. Stakeholder feedback indicates a concern regarding the thoroughness of reviews for proposed new members with prior disciplinary actions. As a principal of a FINRA-regulated self-regulatory organization in the United States, you are tasked with evaluating an application from a firm with a documented history of significant rule violations. Which of the following approaches best ensures compliance with Rule 19H1, notice by a self-regulatory organization of proposed admission to or membership? Option A. Conduct a detailed review of the applicant's disciplinary history, assess the nature and severity of past violations, evaluate any remedial actions taken by the applicant, and prepare a comprehensive report with a reasoned recommendation to the SRO's governing body, citing specific provisions of Rule 19H1. Option B. Perform a superficial check of the applicant's disciplinary record to confirm they meet the basic membership qualifications, without delving into the specifics of past infractions. Option C. Recommend admission based on the applicant's current operational capacity and business plan, deferring any detailed consideration of past disciplinary events to a later date. Option D. Accept the applicant's assurances that past disciplinary issues are resolved and not investigate further, assuming good faith without independent verification. The correct answer is A. Conduct a detailed review of the applicant's disciplinary history, assess the nature and severity of past violations, evaluate any remedial actions taken by the applicant, and prepare a comprehensive report with a reasoned recommendation to the SRO's governing body, citing specific provisions of Rule 19H1. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to balance the interests of the self-regulatory organization, SRO, its members, and the investing public. The principal must ensure that the SRO's proposed admission of a member, which has a history of disciplinary actions, adheres strictly to the spirit and letter of Rule 19H1 under the Securities Exchange Act of 1934. as interpreted by FINRA in the United States. Failure to conduct a thorough review and make an informed recommendation could expose the SRO to regulatory sanctions and harm investors. Correct approach analysis. The best professional practice involves a comprehensive review of the proposed member's disciplinary history and the SRO's specific obligations under Rule 19H1. This approach requires the principal to meticulously examine the nature and severity of past violations, the applicant's remedial actions, and the potential impact on the SRO's integrity and investor protection. Principal must then prepare a detailed report for the SRO's governing body, outlining the findings and recommending whether to proceed with the admission, potentially with conditions, or to deny it, providing clear, rule-based justifications for the recommendation. This aligns with the SRO's duty to ensure that its members meet certain standards of conduct and to protect investors from associated persons with a history of misconduct, as mandated by Rule 19H1. Incorrect approaches analysis. One incorrect approach involves a cursory review of the disciplinary history, focusing primarily on whether the applicant has met the minimum technical requirements for membership without deeply scrutinizing the past misconduct. This fails to address the core intent of Rule 19H1, which is to prevent individuals or firms with a significant disciplinary record from operating within the securities markets under the SRO's purview. It prioritizes administrative efficiency over robust investor protection and regulatory compliance. Another incorrect approach is to rely solely on the applicant's assurances that past issues have been resolved without independent verification or a thorough assessment of the nature of those issues. Rule 19H1 necessitates a proactive and skeptical review, not a passive acceptance of self-serving statements. This approach risks admitting a member whose past conduct indicates a propensity for future violations, thereby undermining the SRO's regulatory responsibilities. A further incorrect approach is to recommend admission without documenting the rationale or the specific steps taken to assess compliance with Rule 19H1. This lack of documentation makes it impossible to demonstrate to regulators that a diligent review was conducted. It also fails to provide a clear basis for the SRO's decision, potentially leading to inconsistent application of membership standards and increased regulatory risk. Professional reasoning. Professionals facing such a situation should adopt a structured decision-making process. First, they must identify the relevant regulatory framework, in this case, FINRA interpretation of Rule 19H1. Second, they should gather all pertinent information, including the applicant's disciplinary history, any mitigating factors presented, and the SRO's membership rules. Third, they must analyze this information against the regulatory requirements, focusing on the potential risk to investors and the integrity of the market. Fourth, they should formulate a recommendation supported by clear, rule-based reasoning and thorough documentation. Finally, they must communicate this recommendation effectively to the decision-making body, ensuring transparency and accountability. Question 19. The evaluation methodology shows that a registered representative with a prior disciplinary action in California, involving a suspension for unsuitable recommendations 5 years ago, is seeking to associate with a FINRA member firm in Los Angeles. The firm's principal must determine the appropriate course of action to ensure compliance with FINRA requirements regarding continuances in membership or participation. Which of the following approaches best addresses this situation? Option A. Rely solely on the candidate's assurance that they have learned from their past mistakes and have no further issues, and approve the association without independent verification or regulatory consultation. Option B. Conduct a thorough investigation into the specifics of the prior disciplinary action, including the nature of the offense and the sanctions imposed, and proactively consult with FINRA Department of Member Supervision to understand any potential implications or specific supervisory requirements for the proposed association. Option C. Assume the association is permissible because the disciplinary action occurred more than 5 years ago and did not result in a statutory disqualification, and proceed with the hiring process without further inquiry. Option D. Delegate the entire responsibility for assessing the candidate's suitability and compliance with FINRA rules to the hiring manager, without direct principal oversight or involvement in the regulatory review process. The correct answer is B. Conduct a thorough investigation into the specifics of the prior disciplinary action, including the nature of the offense and the sanctions imposed, and proactively consult with FINRA Department of Member Supervision to understand any potential implications or specific supervisory requirements for the proposed association. Explanation. The evaluation methodology shows that assessing a registered representative's potential association with a member firm requires a thorough understanding of FINRA Rule 1011 and related guidance concerning continuances in membership or participation. This scenario is professionally challenging because it involves balancing the firm's business needs with its regulatory obligations to supervise associated persons and prevent the association of individuals who may pose a risk to investors or the integrity of the market. A principal must exercise sound judgment to ensure compliance with FINRA stringent requirements for member firm associations. The best approach involves proactively and comprehensively investigating the circumstances surrounding the individual's prior disciplinary history and any potential disqualifications. This includes a detailed review of the disciplinary action, understanding the nature of the offense, the sanctions imposed, and the individual's conduct since the disciplinary event. It also necessitates direct communication with FINRA Department of Member Supervision to seek guidance and understand any specific conditions or restrictions that might apply to the proposed association. This approach is correct because it aligns with FINRA emphasis on due diligence and the firm's responsibility to supervise. FINRA Rule 1011-A requires member firms to file a Form U-4 for each person associated with the firm and to maintain records of such associations. Furthermore, FINRA Rule 3110-A mandates that member firms establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. By undertaking a thorough investigation and seeking direct regulatory guidance, the firm demonstrates a commitment to fulfilling these supervisory obligations and ensuring that any association is permissible and appropriately managed. An incorrect approach would be to assume that since the individual's prior disciplinary action occurred several years ago and did not result in a statutory disqualification, the association is automatically permissible. This fails to acknowledge that FINRA rules and supervisory expectations extend beyond statutory disqualifications and require ongoing assessment of an individual's fitness and the potential risks they may pose. FINRA Rule 1017-A 1 requires member firms to file applications for approval of changes in membership and for certain events, which can include the association of individuals with significant disciplinary histories. Ignoring the nuances of the prior disciplinary action and its potential implications for supervision constitutes a failure in due diligence. Another incorrect approach would be to rely solely on the individual's self-representation regarding their past conduct and to proceed with the association without independent verification or consultation with regulatory bodies. This approach neglects the firm's affirmative duty to supervise and investigate. FINRA Rule 3110-B requires firms to conduct regular inspections of their offices and to review the activities of their registered representatives. A failure to independently verify information and seek regulatory input would be a significant breach of this supervisory responsibility. Finally, an incorrect approach would be to delegate the entire decision-making process to the hiring manager without the principal's direct involvement or oversight. While hiring managers are involved in recruitment, the ultimate responsibility for ensuring compliance with FINRA membership and association rules rests with the firm's principals. This abdication of responsibility would violate the firm's obligation to establish and maintain a robust supervisory system. As outlined in FINRA Rule 3110-A, professionals should adopt a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a proactive, investigative, and consultative approach. When considering the association of an individual with a disciplinary history, principals must 1. Thoroughly understand the nature and implications of the past disciplinary action. 2. Conduct independent verification of all relevant information. 3. Consult with FINRA regulatory staff for guidance and to understand any potential restrictions or supervisory requirements. And 4. Document all steps taken and the rationale for the final decision. This systematic process ensures that the firm meets its supervisory obligation and makes informed decisions that safeguard the firm and its clients. Question 20. Compliance review shows that a registered representative in California has been providing financial planning advice to clients outside of their employment with their FINRA member firm. This outside business activity involves recommending insurance products and receiving a commission for each sale. In the past year, the representative received $1,500 in gross income from these commissions and incurred $200 in direct expenses for marketing materials related to this activity. Under FINRA Rule 3270, what is the correct reporting action regarding this outside business activity on the representative's Form U-4? Option A. Disclose the outside business activity on Form U-4 as the net income of $1,300 exceeds the $500 threshold for reportable activities. Option B. Disclose the outside business activity on Form U-4 because the representative is providing financial planning advice, regardless of the income generated. Option C. Do not disclose the outside business activity on Form U-4 as the gross income of $1,500 is less than $1,000, which is often considered a de minimis threshold for reporting. Option D. Do not disclose the outside business activity on Form U-4 because the representative only received commissions and not a salary. The correct answer is A. Disclose the outside business activity on Form U-4 as the net income of $1,300 exceeds the $500 threshold for reportable activities. Explanation. Scenario analysis. This scenario presents a common compliance challenge involving the accurate reporting of a registered representative's outside business activities. The challenge lies in interpreting the nuances of FINRA Rule 3270 and the corresponding disclosure requirements on Form U-4. Misinterpreting the nature of the activity or the thresholds for disclosure can lead to violations, potentially resulting in disciplinary action. The calculation of net income is crucial for determining if the activity constitutes a reportable event. Correct approach analysis. The best professional practice involves a thorough review of the outside business activity to determine if it meets the reporting thresholds defined by FINRA Rule 3270. This rule requires registered persons to disclose to their member firm any outside business activity that involves investment recommendations, the sale of securities, or the receipt of transaction-based compensation. In this case, the activity involves providing financial planning advice and receiving a commission based on the sale of insurance products, which clearly falls under the purview of Rule 3270. Calculation of net income is essential to determine if the activity is substantial and thus reportable. Net income is calculated as gross income minus direct expenses. The $1,500 received from the client, less the $200 in direct expenses for marketing materials, results in a net income of $1,300. Since this net income exceeds the $500 threshold specified in FINRA Rule 3270, the activity must be disclosed on Form U-4. Incorrect approaches analysis. One incorrect approach involves solely considering the gross income received without accounting for direct expenses. This fails to accurately determine the net income generated by the outside business activity, potentially leading to an underestimation of its significance and a failure to report a reportable event. Another incorrect approach is to assume that any activity not directly involving the sale of securities is exempt from disclosure. FINRA Rule 3270 has a broader scope, encompassing activities that involve investment recommendations or the receipt of transaction-based compensation, even if the primary activity is not the sale of securities. A further incorrect approach is to disregard the activity because the compensation is in the form of a commission rather than a salary. FINRA Rule 3270 specifically addresses transaction-based compensation, making the form of payment irrelevant to the reporting requirement if the activity itself meets the criteria. Professional reasoning. Professionals should adopt a proactive and conservative approach to compliance. When in doubt about whether an outside business activity requires disclosure, it is always best to err on the side of caution and disclose. This involves a detailed understanding of relevant FINRA rules, particularly Rule 3270, and the ability to accurately calculate net income from such activities. A systematic review process, including consultation with the firm's compliance department, is essential to ensure accurate reporting on Form U-4.